right, thanks everybody, and welcome to our live demo. I am here with Alan, who is our
I guess stand-in producer right now.
executive producer. Alan is the executive producer of this show today.
I don't know if I'm exactly qualified for that, so we'll see.
Fair enough. Well, we're going to run through a demo here, and really, what I want to do is just touch on a couple of the interesting feature sets that we've put together over the past few months here. It's been a while since we've done one of these as a live or open demo, so we'll showcase a couple of different things that we've been working through, and we'll kind of take it from there. So, let's get into this. A little bit of background about me. My name's Dan Duran. I've been in this business of valuation, M&A, exit planning for the last 20 years or so. Run an M&A advisory practice, a small boutique investment bank. And really the whole birth of the origin story of Value Scout is working with entrepreneurs and founders through transactions, and so many times coming to the conclusion that the reason that a transaction is not going to work or that a transaction fails is the gap between the perceived value of the business from the market's point of view and the perceived value from the investor, the founder's point of view. So that's what we're trying to solve here, and really put both founders and their advisors in a position to succeed, to increase the total outcomes of a transaction, to have a business that is running more smoothly and better, quite frankly, generating more cash flow, and ultimately gets you to the point of exiting on your own terms. So let's jump into the platform. We'll come back to this slide in a second here, but we'll jump into the platform. I'll start to drive you through it, and we'll see where we go. So taking a stab at this, the way that I look at this, and I'm going to speak to the role of the advisor here for most of this session. Our thesis is that this platform has to be able to put a founder in the position of success, right? If we can't make the founder successful and a company successful, none of this platform or none of this tool set is effective or works. But at the same time, we know that our partners, the advisors out there, are trying to drive ahead and be successful in their own practices as well. And I'm going to speak to some of those issues today of how this platform can really put you in a position to succeed. So look, here's where I'm coming from with this. For you to be a successful advisor in the value creation space or in the exit planning space, I think there's a couple of things that you need to be able to do. And hopefully we help you get there. Number one, I think you need to be able to demonstrate to your client how you are helping them or how you can help them grow enterprise value. Two, we've got to be able to get client buy-in or client adoption on the platform. If we can't do that, if we can't build stickiness, not only is it a waste of time and effort to get somebody onto the Value Scout platform, but quite frankly, it probably means that your assignment is in jeopardy. So client adoption is important. End user adoption is important. Third, I think you need to be able to deliver services at scale. It is easy or easier to deliver professional services against one client. But for most companies, for most advisors, we don't want just one client. We want 10 clients. We want 50 clients. We want 100 clients. And having the tool set that allows you to do that at scale is really what drives financial performance for your practice. And then fourth, and I think finally, is you need to be able to prove your worth so that by the time you get to the renewal period in your engagement, you're sitting in the position to win. And also at the same time, you need to be able to demonstrate your expertise to win the next assignment. So those are the four things that we really want to be able to harp on. And I think we solved for that in the platform here. And we're going to jump in and go through a handful of things here of how we can do that. So Alan, can you flip us back over to my screen here? The first thing that we're going to look at is, actually I'm going to flip over to this. We're going to look at it over here. I want to look at the advisor dashboard. And I know this is maybe an unusual place to start because, the Value Scout platform is about getting into a company, assessing the value gap, and then creating a plan to drive value creation, right? But as an advisor, let's take a step back and look at how powerful this is if you can look at your entire portfolio of clients. And what we're looking at here is, so in wealth management world, we have this concept of assets under advisory or assets under management, right? Value Scout, we've kind of taken a different spin at that. Let's look at your assets under advisory. How much is the total value of companies that you are working on? And how do you compare it to the average advisor on the platform? So in this demo environment, we've got Michaelan is our advisor. She's got $9.63 million in her portfolio, and that compares against 8.11 for the average advisor. So she's doing a little bit better. But if we look over to the right-hand side, she can track her progress against how she is doing in terms of value creation, or her clients are doing in their entire portfolio value creation for this period against the average advisor, 1.4. So she's doing 4x better than the average advisor that's out there. And of course, we're just aggregating all this data, and this is a demo or a dummy environment, so dummy data here. But imagine what you can do with this, right? So if we are sitting here and I'm going out to pitch a new client, it's kind of powerful information to be able to talk about like how fast my portfolio is growing and how my performance is driving value creation versus peers out there. So when somebody looks at your engagement letter and they're asking, hey, how can you justify, $5,000, $20,000, $25,000 a month for this service? Well, that's a lot easier to do when you can say, look, in the past quarter, I've driven almost $6 million of value creation, and that's 4x better than the rest of the market out there. That's how I can justify that fee number. So again, I know I'm coming at this from maybe an unexpected angle right now. The first thing that we're talking about is not deep into the platform on value creation, but this dashboard. But this dashboard for me does a number of things. It gives me heads up view into everything that's going on with my clients, shows me I'm a little competitive, how I am doing versus the rest of the world. And it's really going to help me position for that win with granular data, how I'm doing and how successful I am compared to my peers. Now, hopefully you are the successful side of this and you're not less than the average advisor, because obviously there's going to be somebody down at the other end of the pool. But still, it's pretty strong data. And then just kind of paging through this, easy way to just navigate into your clients. Over here, we can see who's most active. This is important to me. I talk about client adoption or our platform adoption. So understanding who my most active clients are and number of daily active users and these sorts of metrics really can help me dial into who is on track and who is off track. So in this example up here, Yingling looks like they're killing it. And Pizza Kingdom is kind of a laggard, right? They've only have 29 active active logins in the last 30 days versus 269. Yingling is really rocking and rolling there. Now, granted, they may have more users on the platform, but still, it's an indication to me of success. And then one other thing I'll just point out, you've got your to-do list here and what have you, but quick heads up view here of looking at Michaelan's 3 clients. If we hover over our stoplight system here, on track, off track, sort of neutral, we can see that Pizza Co Uno is off track. And once we get further into the platform, we'll explain what this means. But again, stoplight system lets us know where we should start focusing our time. So we can go from an information hierarchy perspective. Up top here is really my scoreboard, how I'm doing, how I grade out against peers, how I'm going to pitch my next assignment, how I'm going to re-win this work when it comes up for a renewal period. And as we scroll down, we get more granular and we can start to really track in and hone in on how my clients are doing. So sort of some interesting things there, right? Let's flip back. I'm going to go back and dive into the platform here. I'm going to navigate just to another case that has some additional dummy data in it. But when we think about our users here, I kind of think about them in 3 different categories generally. We've got advisors that are out there, a value creation advisor, a management consultant that is working with a company to really, be that coach that is, consultant, coach, whatever word you want to call yourself, helping drive value creation, right? They are, some people might say, quarterbacking that process. So, that's one group, right? The next group is executive level, CEO, founder, the person that's going to look at this, but probably not be deep under the hood operating it. And then the third group are your actual day-to-day users. That might be the VP of marketing, the VP of sales, whoever it is, but they're in this platform and operating on a day-to-day basis. So what you'll note is as we've designed this, again, we think of this in terms of information hierarchy. There's a bunch of views in here that are geared towards that executive level, right? So I'm the founder. I log in every single day. I can see what my current value is, and we reset that number every year. We update that. the value gap, difference between what I'm trying to get to and where I'm currently at, and then how I'm tracking against this, right? This little bar chart, a little empty here right now. Flip back up here. So we're sitting here, I'm looking at my dashboard as a company owner or a company user. This is what I see as soon as I log in. Current market value, the value gap, difference between where we're driving this ship to and current value. And then this progress bar, we might think of this as a burn down chart of progress against that plan. And our little green bars here, they're kind of low on this example company, are showing us how this tracks. What's interesting is if you think about, and I'm going to get into the valuation stuff and how we cook value and get into it and the algorithm and everything, but really the valuation piece of this is just keying up our algorithm, is helping us do some fancy math here, is getting that baseline value. But exit planning and value creation is all about the activity, right? It's all about the plan. And where those green bars are coming from is over here in our planning matrix. So we have an annual plan, we have a quarterly plan, and it lets you get in and start to work through all of these plan initiatives. And we can get down pretty granular here. So here I'm looking at a quarterly plan, working through like all of the initiatives that are going to spit out value creation. As I knock these things off the board, you'll note that we have a value that is attached to them. That's what's flowing up to our dashboard. So it's filling up our burn down chart here of value creation. It's pretty cool. As the CEO, I can log in at any single point in time and look at how we are progressing against plan and whether we're on track or off track. So kind of an interesting, high level view. You'll note that throughout the platform, lots of this like visual stuff here. How are we tracking progress against, percentage of plan completion against percentage of value creation? Leaderboards. How are my people doing? So, I'm looking over here at my, the quarterly leaderboard for fourth quarter 2021, and we can see that Bill, the HR pro, has got 2 of his 6 objectives or 2 of his 6 initiatives completed. But he's put $1 million on the board, one out of $1.3 million of value creation. So this kind of granularity, these sort of leaderboard, our objective here is to create some competition, to gain visibility into performance of who's actually doing what for me and how we are knocking down value. And also then to start to do some more sophisticated planning. What's the workload of, Emily here, who's got only one initiative for this quarter? Maybe it's a really big initiative, but can we really load her up a little bit more and get her more active in this value creation process? So this is high level, right? As the CEO founder, I probably don't really want to be down in the weeds on everything that's going on. I need this high level view. But every single thing that we're looking at here, we can drill down into and get increasingly more granular to the point where we are messaging back and forth on any given task or any given subtask to get to that level of granularity. All right, so I want to back up here a little bit. One of the other things that we've been working on, and I'm going to assume that you've been through the platform a little bit because I'm going to skip around here. One of the other things that we've been working on is this AI recommendation engine. So common complaint, feedback we get, comments out from the industry is, we go through a evaluation process or we go through some sort of discovery and assessment, and we don't necessarily know how to create action items, things that are actionable out of that discovery process or even out of that valuation process. So what we do is, and this whole engine, this recommendation engine comes from, our experience, my experience working with thousands of companies over the last 20 years, deep inside every one of these processes. We've built this recommendation engine. So as you and the user, you and the CEO founder or company staff work through, say, the value assessment, our system is going to start to kick out recommendations of things to really start to think about and look at. And they're not perfect, right? Like they're a starting point. As a military guy, I think of this as like seeding the battlefield. You work through this value assessment, sort of a questionnaire process, if you will. It's truly a discovery process for the consultant that might be involved here. But we're going to start to kick out recommendations. And from there, you can look at them, you can modify them, you can reject them if you want to, or you can make your own. But what we're doing is seeding the battlefield. We're giving you ideas of where best-in-class companies should be spending their time. And you get to make a value judgment afterwards of whether you want to spend your time there. But our recommendation engine is going to start to kick things out. So I'll show you what that looks like real quick. I'll flip over here to another case. Looking through this, we might have gone through, let's say, this value assessment. We're going to go through. You got a whole series of questions that you go through. You might have answered something over here, and based on this answer and what's going on, beer is good. It's a great example that we got. This is Alan, I think, that probably wrote this. I can't disagree with him. But guilty, right? But as we go through, there's probably 60 to 80 questions in here. It's going to change because there's some logic that filters into how many questions they go. We get into this list of findings, and our suggestion engine starts to kick out all of these findings, these suggestions, as you go through it. So, one of the questions that we asked through this thing out was, you need to decrease owner dependence. It's one of the biggest issues that we see impacting companies and their value. You've got a single owner. They are, highly controlling. All decisions run through them. Maybe they control all the customer relationships or maintain most customer relationships. If Bob or Sally, the owner, get hit by a bus, this business is done. So in this case, our system has kicked out this recommendation. Being hands-on is great, but it's worth to start to step back and decrease that independence, because, quite frankly, it's the kind of thing that decreases value when you try to go to market. So we'll kick these things out as you start to work through this entire process. Recommendation engine is a pretty cool feature. So let's flip back. I'm going to come back to. I'm going to go back to the top here. Talk about valuation a little bit, because valuation is really kind of what sets the table, sets the stage for any sort of value creation process. We need to baseline performance. We need to understand where this company is starting from in order to figure out where we're going to. I don't know how to. I was talking to Alan about this the other day. We don't know how to get to Albuquerque unless we know what our starting point is. If we know the starting point and where our end point is, we can draw out the directions to get there. So valuation sets the table for that. Now, most valuations that you see historically are, 60, 100 pages of really dense text and lots of boilerplate, and it feels like a really awful tool to get to just baselining value for an exit planning assignment. So we take a different spin on that. Here you see it's just very visual, right? Like, we'll go through an entire process to get here. Algorithm-driven process. We've got some human review, or human QA, as we call it, in there to make sure our numbers are right. But what we're looking at here is just a dashboard. Back to the same thing we saw earlier. Current market value, the value gap. We're showing the spectrum of value here. I always think that this is important because value is not just linear. It truly is like a normal distribution or a bell curve. And frankly, most companies are going to, it's a bell curve. Most companies are going to sit in the middle of this thing and not be at the upper end of range. So if you are staking your hopes on being a best-in-class company, think about what, the standard deviation stuff. 3 standard deviations, you are better than 99% of other companies out there. Well, that means you're pretty awesome. And it also means it's pretty unlikely because everybody else is trying to do the same thing. But what we do is we map out here where you are sitting on the bell curve and what best-in-class is. TMV is theoretical maximum value. We're projecting that out, saying if you're operating at best-in-class, you could potentially be $23 million. Kind of good stuff to start to think through. And, so this gets us to, in this entire process, gets us to current value. Also important, it's a pretty easy upgrade path for us from here to either upgrade to a written deliverable. Again, our goal is to just keep everything on platform and keep it simple, but we can kick out a written deliverable. We can also upgrade this to a certified valuation. So here, we're not meeting valuation standards from NACVA or ASA or any of the sort of certifying bodies, AICPA. But if you need a valuation for a divorce, for litigation support, for a shareholder agreement, the upgrade path from here, the work that we have laid, makes that upgrade to a certified valuation pretty straightforward, and we can actually kick that out the door as well. So how do we get here? How do we we're drilling down, right? If I'm the CEO, I care about this stuff, these high level numbers. But how do we get that? we've got this value assessment. This is where it starts. We'll have collected a whole bunch of data and financials and ingest that into our system, and algorithm is pumping through it. But we really want to get deeper into this value assessment, this questionnaire process. What is cool about this, if you are an advisor, and especially if this is your first time working with this company, if you are an advisor, you need to go through a discovery process to get deeper involved in the company, to understand what their strengths and weaknesses are, etc. Working through this value assessment is your opportunity to do that. You've got, take as much time as you need to, ask as many questions as you want. This questionnaire is, I said it before, it's somewhere between 60 and 80 questions. It's going to range based on some branching logic that goes into it. Also, industries will change it a little bit. But you're going to work through this. And these questions are designed to do a couple of things. One, tease out risk, right? Because value is a function of risk. So the way that we've designed this, the questions help us understand where a company sits in that risk profile, in that bell curve, right? But two, there are all sorts of embedded activities, embedded problems that that get surfaced working through this. So Alan, if you'll flip this back up there again, one that that I'll highlight here, the ownership section. So let's look at this. So as I'm scrolling down over here, we've got 6 questions in ownership. You'll note that we've got some red twos and ones up there. That means that we've got some messaging going on back and forth here. So let's click into this one. Does the company have a buy-sell agreement in place? Simple yes or no answer, right? So the question is, alarmingly simple, right? They don't have a buy-sell agreement. But as many of you know, if the company has a series of shareholders and they don't have a buy-sell agreement, what are the problems? All sorts of things could potentially happen, right? Somebody gets hit by a bus. What do we do? How do we buy that person out? 2, we have some partnership strife. We deal with this all the time in our valuation practice. 2 partners can't get along. How do we break up? Without a buy-sell agreement, we are potentially going down the path of litigation and being in a courtroom and hiring a lot of attorneys to work on this. So buy-sell is important. So our embedded activity here, the related finding is consider completing a buy-sell agreement. And you'll see down here, this messaging system, you'll see that I was messaging back and forth with McAllen earlier this morning about hey, let's flag this thing for follow-up. We want to make sure that we maintain visibility on it. It's not super urgent, but at some point in time, we need to get to this thing. And we messaged back and forth. We flagged it. We created a finding. It's going to go in our big bucket of work undone that we call findings. And we're going to come back and work on that. Now, think about this just a little bit further. If you are, say, wealth manager that sells insurance, as well as securities and advises on assets, that one of the things that we should probably be doing is funding this buy-sell agreement, right? So now you've got visibility into this company. You realize that they don't have a buy-sell agreement in place. That's probably an opportunity for some legal work as well. But the next question that popped up was, is the buy-sell funded? And of course, if it's not funded, it's not here. The next activity is, well, let's actually go out and find some insurance for that once we get the buy-sell agreement in place. And you'll see here, McAllen flagged that, right? I went ahead and flagged this with a finding, since we'll be talking about it as we get the buy-sell in place. So we're maintaining visibility on it. We're not necessarily going to work on it today. And for the other folks that are in the room, they're on the advisory team, the attorney, the CPA, the wealth manager, etc. All of this stuff, this sort of hidden work, this advisory debt that exists out there, we can start to flag and start working on, because these are diligence traps. And by the time we get to the point where we're selling the company, we should have these things buttoned up. So they're fee opportunities, the revenue opportunities for lots of folks that are around the advisory table. But at the same time, they're things that we need to get buttoned up before a transaction. This is some of the exit planning kind of stuff. So super important, right? Working through this entire process gives us the opportunity to really get deep, to work with the founder, work with their executive team, understand the company, understand where the problems are, but also start to flag things that need to get fixed, and other work opportunities, follow on revenue opportunities for either us or our network of advisors out there. So where does that go to, right? We finish this up. I mentioned the recommendation engine before. Findings are our big giant list of work that is undone. And, we can create a finding from basically anywhere. All this is maintaining visibility of everything that we're working on. Like this one, zombies are not efficient in the workplace, increased productivity. The whole idea is if zombies are not efficient, we are flagging this as a thing not to work on right now. We need to resist the urge to fix everything right away, but we need to fix it sometime. And from here, this is how we flow things into a plan. All right, so stepping back, a couple other things that I want to talk through, financial questions and financial performance. So depending on your role and your viewpoint, company financials can sometimes be opaque. Sometimes it is surprising how poorly a company understands their own financials. So as our system works through this valuation process or valuation assessment, and we're crunching on numbers, we're going to notice anomalies. And we need to sort of right size and rectify those anomalies before we can get to ascertaining value. So what we do here is the system will push out financial data in the form of a question here. We see the charting. Alan, can you pop that up there? So we're sitting here, we're working on a company, system flags with this advertising revenue. Really spiked in 2019 and then falls back down to sort of a normal rate in 2020. And that's going to skew valuation a little bit potentially. So we want to understand why that was so far out of whack. And again, because as an advisor, you might not get this level of detail and understanding of your company, of your client, and oftentimes the companies themselves don't have awareness of these sorts of things. We're pushing this data in, flagging problems, and they can also become findings, but it also helps us dial in valuation. And then finally, just the last piece on valuation, let me get out of this, financial performance. So, on one hand, not super sexy, right? We're just charting financials, but at the same time, not information that many advisors get deep insight into. And throwing this up on a page and understanding like what our trends look like. This, for instance, the difference between EBITDA and adjusted EBITDA. Well, if we're sitting here and most of our earnings is made up of adjustments, that's a risk to me. And it's something that we should be like really thinking about and talking about, where our financials should represent actual performance and we shouldn't need to adjust 90% of our earnings to get to adjusted EBITDA. But again, this is just some charting that you'll see that's in here based on all of the data that we've ingested. I want to talk real quick on this concept of exit modeling, sort of switching gears here. So if you think about, you've got a company, this is a pretty standard scenario here. So Pizza Kingdom is worth about $10 million today. The reason that Pizza Kingdom is not going to market, like most of our clients, is because $10 million does not cut it for them in terms of what they want out of the transaction. So this exit modeler, this is great for level setting expectations with clients. It's great for wealth managers to get this sort of insight. But what we're doing here is we're looking at past performance, comparing it to what a founder is trying to get to. So in this example, you'll see here where my cursor is, blue lines or blue columns represent past performance, green represents future. And this purple line here just extrapolates out what performance is likely to do based on historical average growth rates. And we've said, okay, Sal, Sal's the founder of Pizza Kingdom. We've said, Sal, how much money do you need out of this thing? And he says $25 million. The next question is, when do you need to get there? And he says 5 years. Super common numbers. Like I hear this all the time, almost exactly in this way. So what we've done is drop that in, and now we can see, okay, well, dang, we need to grow at 21% for the next 5 years every single year in order to hit those numbers. And knowing that we've been growing at 2% a year feels like we're not going to do that, right? So what we can do is we can change some of these variables, right? We could say, what if we need to do, what if we did this in 15 years? And we change the numbers, we see what the charts look like, and suddenly it looks a little bit more likely, right? In 15 years, potentially we would get to $25 million of value, but Sal is like, I kind of want to retire in 5 years. So maybe that's not going to work. So we can change this back to, 5 years. And we say, Sal, how about $20 million? Will $20 million get us there? I mean, the numbers still aren't going to work, right? It just looks a little bit better. And he says, absolutely not. I'm not taking less money. I still want $25 million. So look, you know what? The answer is is right here in this gap. The difference between the current performance and this baseline performance, that is change. That's what that represents. And that represents, as an advisor, your either workload or your opportunity to create change in this company and bend this growth curve to get to Sal's goals. So that's great. Like as the value creation advisor, that's where your job comes from. Now flip this around. Imagine if you are a wealth manager and Sal is a prospect and you've been, sort of courting Sal for a while. You've been taking him to lunch and playing golf with him, and you're like kind of nudging this thing along. You don't have a ton of visibility into this company without Value Scout. You don't have a ton of visibility into this company and performance. But look, if you're sitting here on this platform right now and you're looking at Exit Modeler, you've got Sal, who's got a $15 million value gap. The growth rate, 15.74% versus 3 is not even close. So the likelihood that Sal gets to his $25 million in 5 years might feel a little bit low. Now, what if you had another company that, the numbers were much closer? He wants, $15 million and the growth rate is only a couple of points different than historical. Can you think about what you would do with that? Can you think about what you would do with that information, right? So I'm the wealth manager. I've got company A, Sal, whose growth rate is totally out of whack with historical for what he needs. And I've got Alan, who's got his company. Growth rate is within a couple of points hitting his numbers. If I'm waiting for that transaction to happen because I want to catch those assets for that liquidity event, which is a better prospect, right? So we know that Alan is more likely to hit his numbers. Sal is a reach. So we certainly want to continue on with this assignment through this value creation thing because that's Sal's goal. But I'm going to put my eggs in the Allen basket, right? So if I'm thinking about my portfolio of prospects, I've got 25 prospects that I'm chasing out there, and I start to get visibility on this platform of how likely they are to hit their exit goal. Well, I can start to tier my clients into A's, B's, and Z's. My A clients are the ones that are short-term exit, high likelihood to hit their numbers. My B clients are maybe medium-term exit, the 3 to 5 year window, and the gap between past performance and future performance isn't that big. My C clients, the ones that I'm probably not going to bring out to golf games, or certainly not use the good seats on when we go to the Knicks, right? We're not blowing the good seats on who's it? Sal. Sal's got the bad company, right? Sal doesn't get the good seats because he is a high risk client. He's in the C category, and he's got to start doing better for the next few years before he gets back into a suite, right? I mean, that's kind of how I look at this. But that's what this exit modeler is all about. It is level setting expectations for value creation advisor or management consultant and the client. We kind of negotiate whether we are likely to hit plan and whether our expectations are reasonable. And this visual is really compelling. It's visceral when they look at it and they're like, I'm not going to get there. And then from the wealth manager, man, this is helping me segment my prospect list and understand where I should be spending my time and resources versus the folks that I put on the back burner. So it's a pretty cool little tool. This to me is the thing that creates activity. Every time that I walk a client through this is their light bulb moment. Valuation is fine, but this is their light bulb moment that makes them say, okay, I get it. I need to do something. I need to make change, right? So, got a little bit of time left here. Let me jump into planning. I'm skipping over a lot of things on the platform here, but the planning matrix here, probably the coolest thing that I don't think you'll see anywhere else is this number right here. When we have an item that is in our plan, we can actually, through our algorithm, attach a value to it. So I'm just going to click into one. We're going to edit this sucker. We're going to click into advanced. What we're trying to do here is make every single initiative count. So back to Sal. Sal said, I've got $15 million of incremental value I need to make up in the next 5 years. I need $3 million of value this year. It means everything that I drop in my plan should have some sort of value to it. So for this one, I just picked this randomly, right? But we've got a couple of different ways to do this. We can either grow revenue, we can drop cost out, we can increase gross margin, we can acquire another company. Our algorithm is going to chew on this, and we're going to make an estimate of what these numbers are, and bam, that initiative is now worth $888,000 of value creation. and where that flows back into. I showed you this here a little bit earlier. On the dashboard, those bars are going to start to creep up based on that incremental value creation. And we're going to see, like when we look at what we call our retrospective, the plan period dashboard, how we're doing on value creation. So you cannot hit that $3 million of incremental value if you are not intentional about it. And by working through every one of these initiatives, dropping a value into it, using the algorithm, doing a little bit of analysis on how you get there, let us do the heavy lifting on the math. That's how you start to have a deliberate plan to create value. So I won't get into the planning matrix itself. This is a Kanban. It lets us slide things out through various different quarters in the future. A couple different views to look at. A lot of people like this Kanban view of to do, in progress, complete it. But again, let's think about this from the CEO's perspective. This is what I care about, right? I care about my retrospective. I want to know who's on the leaderboard. I want to know who's the laggard. I want to know who's doing their job, who's got excess capacity. These are the kind of things that I think about. And that next level down is the planning session and making sure that we drive accountability, in those planning boards. And then finally, this is like super nerdy stuff here. But if you are the nerdy type and you want to make sure that we're driving performance, of course, it is all about execution and what you're knocking down in the plan, but also about what you are not doing. So disposition, what happens at the end of a period? What happens to things that aren't done? And as one of our partners says, everything gets shot in the head. Every single initiative, Alan's laughing at me, but it's true. Every initiative dies, and we need to start them over. But we need to do that root cause analysis on why they died. And what we do here is you just flow through this. Every time you have a thing that's not going to get completed, we need to actively make a decision. Are we going to roll it forward? And if we're not going to roll it forward, did it get abandoned and why? So here we're starting to do some of that assessment. You see that both Bill and Sam have a total of 4 tasks or 4 initiatives for the quarter that haven't been completed out. And Sam rolled one over and Bill canned one. So why did he abandon it? That's a great question. I'd want to know that. Like, why was it so important that we put it in our plan to begin with, and now we don't think it's important enough to ever do again? So this is the nerdy operations kind of stuff, but this is sort of the making the sausage level of how we actually get good at completing stuff and making sure that we're putting the right amount of work into a quarter, into a period, and completing it out. So, Alan, back to you. Am I missing anything else here that you think we should be talking about today? Or we're going to call it a wrap?
I think this looks pretty good, man. It's pretty sharp.
Okay,
it's
cool.
a good-looking platform, so.
It is, right? Mm-hmm. All right, cool. So we're going to call it a wrap for today. If you flip to the last page here, Alan, hit us up on social, all the LinkedIn, Facebook, your Twitters. We in Twitch? In Twitch? Not on Twitch?
Not in Twitch or TikTok. We're
TikTok.
not dancing around it.
All right, no TikToks. But if you want to catch us on the socials, we're up there. So go ahead and hit us up, reach out, hit that link if you want to jump in. We'll do a private demo. I know I went through this pretty quickly here, but happy to kind of just take through it, answer questions to your specific use case, and we'll take it from there. So thank you for your time, and we'll see you next time.